Are we not paying enough attention to the risks that this poses?
I don't think we are. I think investors got a sobering reality of what the Fed intends to achieve here over the next 3 to 6 months, which is price stability, and they're more than willing to risk a recession in order to do it. And equities have been the drunkest asset class at the party, and now the Fed that removed the punch bowl. And I think we're pricing in this new lower economic environment, and more importantly, earnings expectations are way too rosy for the next 12 months into 2023. So recession risks have risen, and my base case now is a recession slightly over a soft landing.
So where are you seeing opportunities where you're still comfortable being constructive or overweight in the equity space?
Yeah, you got to pick your spots. I do think it's a stock picker's market, but from a sector perspective, I do think that energy is very attractive here, especially after the sell-off that we've seen over the last couple of months. Valuations are pretty compelling. You haven't seen a lot of investment come into that space, and it's a very tight global inventory situation. Even if you do see slower economic activity, I think energy is going to hold up just fine. I do like utilities and consumer staples. These are bellwethers that you want to run to in periods of volatility, and I think it's interesting that utilities and energy are the only two S&P 500 sectors that have over 90% of their constituents above the 200-day moving average, which is a rare occurrence when you've had such a rally over the last 2 months. So again, energy, utilities, and consumer staples are my favorite sectors.
Jeff, I want to come back to this question of QT in Jackson Hole over the weekend. On a couple of the panels, several people talked about the fact that quantitative easing seems straightforward. It's quick and you can do it. But quantitative tightening may prove to be much more complicated and take much longer to work its way through the economy. Is this something that could add to your bet on recession?
Well, if you think about the rate hikes that are being priced for the first year of this hiking cycle, it's the second fastest start since 1955. So there's a lot of tightening in a short period of time, which adds to this idea of a policy error by the Fed. But now with QT doubling in September, you certainly are amplifying those risks. But I'm not really concerned about the quantitative easing going to $95 billion per month here because you're not really adding any real duration into the markets that the markets are going to have to absorb. Again, a lot of it's going to be maturity securities that are maturing, or they're going to be T-bills. But as we move further along in the quantitative tightening process, call it 6 to 12 months, I'm going to get more concerned about the liquidity draining that's occurring in financial markets. But that's not a near-term concern for me.
Okay, so what's the biggest risk right now to your outlook? If you've got that kind of risk, again, unknown, hasn't happened before, how do you play that? Do you sit back and wait to invest? Where do you find investments to hedge? What do you do?
Well, I think you want to actively sell rallies in this environment. It wouldn't be a surprise to me if we retest the lows that we saw back in June. But I do think maybe the biggest risk to equity markets right now is maybe a stickier inflationary environment. And we're certainly not going to get that from August CPI by looking at the Cleveland Fed nowcasting tool. It's going to be another weak print, but the Fed is clearly going to be looking through that. But also, if you continue to see strong labor market activity and a strong payrolls report on Friday, given the JOLT survey that we got yesterday, that means that the Fed is going to have to raise rates even more aggressively than it's being priced and ultimately cause a harder landing or a deeper recession than what I'm anticipating.
Are you expecting the earnings cut cycle to be quite brutal? Where are we at with that, and how are multiples too high at the moment, and by what magnitude do you see that?
Yeah, I'm anticipating a pretty robust negative earnings revision cycle. If you look at Q2 earnings, I think investors got that wrong, with over 40% of S&P 500 companies actually seeing negative real revenue growth. So I think margins are too optimistic. And if you look at the last 3 recessions, you've seen earnings expectations go down by about 25% on average. If we end up avoiding a recession, soft landings usually see about a 4% negative earnings revision. So given the fact that we don't know whether a recession or a soft landing will happen, my base case is I think earnings expectations need to ratchet down anywhere from 10 to 15% from the all-time levels that we saw just a month ago. So I think that's a rosy environment. It's clearly not priced, and I think that's going to put pressure on equity markets over the next 3 to 6 months.
Jeff, how are we going to know when the stock market has bottomed?
You're never going to know that until we have some hindsight. Picking a bottom is notoriously difficult. But what I will say is that once you enter into bear market territory officially, you hit that negative 20% level, it's a good time to start thinking about dollar cost averaging into equities, because once you hit negative 20%, the markets on average go down another 15.7%. However, if you bought the day that that bear market happened, even though the markets continue to go down, looking out 6 months, the markets are up 4% on average. Looking out 12 months, the markets are up 11.8% on average. So again, I would be selling rallies given that we're not technically at a bear market yet again, but once we hit those thresholds, start dollar cost average for opportunities that will likely pay off as you look out on the horizon.